$31 trillion. That's the jaw-dropping amount of national debt the United States has racked up, equivalent to a mountain of cash so colossal that wrapping your head around it feels like a scene out of a surreal dreamscape. It's a figure that, much like a ticking time bomb, casts an unavoidable shadow over the global economy. Now here's the kicker. Just like in 2008, we're stumbling into a financial quicksand, but this time it's debt, government, and private equity that's pulling us down. Remember the chaos of 2008? Toxic mortgages, reckless Wall Street gambles? Fast forward to today, and it seems history's got a peculiar way of echoing itself. But instead of mortgage-backed securities, we're now flirting dangerously close with debt levels that could shake the foundations of not just Wall Street, but every main street across the country. What's contributing to this replay of financial jeopardy? Well, picture private equity firms circling distressed companies like vultures, leveraging massive debt. They promise revival yet often squeeze businesses dry. Combined with an ever-growing national debt, this cocktail might just need a spark to explode. It's like standing on the edge of a financial precipice. Again. Now let's dive deeper. In the past decade, private equity has become a major player, virtually reshaping the economic landscape. These firms swoop in, buy struggling or even healthy companies using borrowed money, and drastically restructure them. Sounds like a savvy business move, right? But here's the trade-off. This process often leaves these companies saddled with enormous debt and stripped of their assets. Once they've extracted all possible value, the firms often step back, leaving a skeletal company behind that struggles to survive. We're living in an era where companies that once flourished are now teetering on the brink, propped up by a financial framework that resembles a house of cards. Just a minor shift in economic winds, higher interest rates or economic downturns, for instance, and the stability we take for granted could collapse like a poorly built Jenga tower. But how did we get here? Partly, it's a matter of repeating past mistakes, where short-term gains are prioritized over long-term stability. Today, just as in 2008, oversight often lags behind rapid financial innovations, leaving gaps that these economic powerhouses slip through. It hammers home the lesson we seem to keep missing. Without careful handling, our financial decisions today might haunt us tomorrow. And while the spotlight often shines on big players, it's the average individual who ultimately pays the price. Imagine the everyday workers tied to these companies. As their employers are overwhelmed by debt, they face job instability, wage stagnation, and diminished benefits. It's a domino effect. The uncertainty trickles down and spreads across communities, rippling through consumer spending habits, housing markets, and local economies. Let's not forget the impact of government policies in this mix. Think about the stimulus measures and low interest rates designed to boost the economy. They also encouraged risk-taking, much like pre-2008 times. With cheap money readily available, businesses and financiers alike dove into riskier investments, believing the economic good times would roll on indefinitely. It's a precarious balance. Economic rescuers are often the same enablers of future turmoil. As private equity capitalizes on these opportunities, the systemic vulnerabilities deepen. But here's a startling thought. Unless there's a fundamental shift in fiscal responsibility and regulatory oversight, we're setting ourselves up for another fiscal reckoning. We need future-forward financial stewardship, innovative yet cautious, to guide us safely through these economic minefields. Because if history's taught us anything, those who ignore its lessons are bound to repeat its errors. Let's zero in on regulatory oversight, or sometimes the lack of it. Back in 2008, we witnessed what happens when financial institutions operate with little scrutiny. The fallout was catastrophic. Fast forward, and it seems we're tiptoeing around the same mistakes. The regulatory body faces immense pressure from powerful lobbyists, resulting in policies that occasionally prioritize corporate profits over public good. It's a precarious dance between fostering growth and preventing another crisis. But as we've seen, a single misstep can send shockwaves through the global economy. Consider the ever-increasing complexity of financial products today. They might be marketed as opportunities, But hidden underneath are layers of risk that echo the infamous mortgage-backed securities of the last crisis. As consumer confidence gets blindsided, the question arises, are we equipped with the right tools and foresight to prevent a rerun of past disasters? Yet, not all is bleak. The silver lining is that awareness is increasing. More people are scrutinizing these practices, calling for transparency and accountability. A collective push for change is the need of the hour. It requires vigilance, education, and action from all economic stakeholders, government, businesses, and individuals alike. The goal? To steer us from the brink and forge a future where prosperity is shared, not hoarded. This isn't merely an option. It's a necessity to avoid déjà vu on a devastating scale. So, where does that leave us? At a crossroads, really. A pivotal moment where decisions made today could define the economic contours of tomorrow. We must ask ourselves, how can we reshape the financial landscape to prioritize resilience over short-term gains? One potential path is re-envisioning the role of private equity and debt. This might sound daunting, but imagine a world where investments are driven by sustainable growth rather than quick profits. This means encouraging policy shifts that reward long-term investments, not just those engineered to boost quarterly earnings. Encouragingly, some forward-thinking investors are already seeking out businesses committed to ethical practices and sustainable development, betting that these are the true drivers of stable growth. It's about building what some like to call a circular economy, one that values resources, people, and planet in the same measure as profits. Public awareness also plays a vital role here. The more informed we are, the better we can steer the economic dialogue. Whether it's through voting, advocacy, or simply choosing where we bank and invest, every decision becomes a stitch in the broader fabric of financial reform. But the window for action is narrowing. The rise or fall of our economic future hinges on intelligence, accountability, and transformation, a triad not just necessary, but mandatory. It's time for bold steps forward, not cautious sidesteps around the same old pitfalls. Let's make sure we're on the right side of history with lessons learned and wisdom applied. As we stand here at the intersection of past lessons and future potentials, it's clear that action can no longer be a passive option. The way forward demands that we choose responsibly, prioritize sustainability, and hold all stakeholders accountable. Remember, the echoes of 2008 don't just serve as warnings. They're a call to arms for a better, more equitable economic system. Now is the time to engage. Look into the practices of companies you support, demand transparency and accountability, and make informed decisions that align with your values. Vote for policies that foster economic stability and protect all levels of society. Your voice and choices are powerful tools in steering the course of our collective financial future. So, let's pledge to make them count, to be proactive participants in shaping a resilient economy that works for everyone. Together, we can ensure that this time, the story has a different, brighter ending. Let's go out and be the change we need right now. After all, the future depends on the choices we make today.